It's going to be a video on order flow, in which, in my opinion, it's literally the best thing. So, um, this is just the way that I use it. You guys could like look this up yourselves. Everybody, like most people, understand this already. So I'm just gonna explain how I use it and how we could pair it with the way that we trade. And yeah, it's a very good tool to have. I think this is the biggest misconception in the market is that people just focus too much on the mechanical approach and then they just base everything off of an entry. But if you don't understand order flow, your entry is just basically a gamble. It's a roll of dice. So this is just going to help clarify everything and just make everything easy. So yeah, let's start. So order flow is just basically a fancy word for trend, right? Clearly we have an uptrend. This is the new higher high, higher low, higher high, higher low, higher high, higher low. Basically swing high, swing high, swing high, swing low, swing low, swing low. Okay, if we're in an uptrend and we are looking to continue higher, but let's just say we swept out London's high, this is New York open, London's high, there's nothing above. If price closes back in here, right, but doesn't close below here, the swing low, would you say that price is going to go up higher, or would you say it's going to continue lower if we don't have anything here? As long as we don't close below here, we can potentially go higher. But unless we close below here, we're more than likely gonna start a new trend, and this would be our pullback area. There'll probably be, price will present itself. Maybe there'll be an inversion here after we sweep out this high, this liquidity, or there'll be a order block here, and we start to continue lower, and this is the start of a downtrend. Now this is the major high, this is a swing high, swing high, swing high, lower high, lower high, lower high, lower low, lower low. Okay, and if, same thing, if we are trying to look to go above, would we take a long here, or would we take a long once we break above the most recent swing high? If you said we're gonna take a long or look for a long above the most recent swing high, you're right. If you say that we didn't, but also to be careful, be mindful, not careful, is if we sweep out a major important, until we sweep out or we tap into a higher time frame PD array, and we don't close above here, that doesn't mean that we won't go higher, as long as this isn't an important sweep, previous day low, previous session low, or we're not tapping into some form of PD array right here. Then yeah, we are not, most likely not going to continue higher. We could probably come about right here and then go lower, or we could come here and go higher. The fact is that if we don't close above here, we're not going to look for a new trend to go higher, because this is the swing high. Order flow starts to change once we have a closure above swing high. Okay, in these pullback areas, right, this is our job, is to look for some form of entries to follow the trend. And what I mean by that is, this is the swing, this is the major high, this is the swing low. Now, once we close below the swing low, the pullback between the high and the swing low, there'll be something presented here. Maybe whether it be a fair value gap, it be an order block, a rejection wick, or whatever the case may be. We're supposed to have a mechanical approach between here and here, okay? Because these are our pullback areas that are confirming the trend for us. And thing here, it would be like this. This would be like this. Let's just say, obviously, it's never going to look this clear cut, but you understand what I'm saying. As long as you could point out your new higher highs, higher lows, higher highs, higher lows, swing high, whatever you want to call it, you'll be able to tell. It's never clear cut, but this is just an example. Okay, until we look for a different direction based on order flow, we could either follow the trend or go with the trend, like as opposed to once we have a major form of liquidity being swept. Obviously, this is just a sweep here, as you can see, and then we displace lower. Yes, you can be brave and try to top tick depending on your mechanical approach. Like, for an example, we like to use the 8.5. Yes, you can sometimes take trades just based off of the 8.5. I wouldn't recommend it until you have a little bit of market experience, but this would make the most sense. That's the only time we would take a reversal trade based off of something like that, or if there's another form of liquidity being swept into, or this is just based off of the high being tapping into a rejection wick. And you already know how we use rejection wicks. We could either use the 0.25 or the 0.5, or we could use the golden opportunity, where price comes and taps into the 706, and then we enter lower, we displace lower. Same thing goes for the bottom, unless this is a rejection wick here and we're looking to go higher. We wouldn't just basically take the trade. That's 0.5, 0.25, you know. Yeah, so we can get into some examples. I will do the one from yesterday's price action. Let's see. There we go. What's this? Wednesday? What's it? Okay. We could even do, yeah, let's do today's, just an example of today. Okay, what do we have here? Price tapping into a higher time frame PD array. We have confirmation that price is displacing lower. We got a candle closure up below this low. This is the last low in the swing high. Right? Swing high is here. Low, high, low, high, low, low, high, low. You know, same thing like that. Okay, we go into today's market. 15-minute is the time frame alignment. Where's price? Okay, let's see, okay, 9:30. We close below. You see how time frame is important. It's this 4-hour area where the candle closed below. You could see from right here, like you could have even, once we inverse this, we could have came for the tap, traded back down. But in this case, let's just say another confirmation. This is the high, this is the low. Now you have two time frames in sync with one another. Time frame alignment confirming to you the overall trend. On a higher time frame is confirming that we're going lower. Now to look for an entry. Obviously, you know, we trade 15-minute confirmation is a 1-minute entry. We wait for our open, being that we have confirmation on the 15-minute. Market opens. We already know to go, we're bearish. What do you have here? You have a secondary leg. You have the max expansion filled to the T. You have a gap fill. You enter here. Also keep in mind, wait, let me just point this out to you guys. All right. We have lows here. Okay. We have London low and Asia low that haven't been swept yet. Okay. It's not gonna, like, I gotta zoom in all the way in for it to be accurate, but let's just say that's the low point. You don't have to target this gap. Let's just say we wanted to target out liquidity. 10-point stops. You have basically zero drawdown for 137-point profit, like take profit. Okay, that's literally the example from today. We could use last night's example as well. That's the one that I took. I took last night's trade during Asia. I don't know. I seen it and it was clear cut to me to not take it. Why not? So this was the example that we had. Let's just go right here. It's this one. Okay, this is the example we had, but I was watching it in real time. So once we on the 15-minute tapped the CE, I waited for it to displace out of it, right? I knew we would sweep again. We had this SMT here. I was confident that this being the new swing high, I would wait for price to close above it. That's where I would enter. Price closed above it. Boom. I went to the 1 minute. Right. This was a gap, but I didn't really trust it because as soon as we wicked above it, we closed back beneath it. So what I like to use is once we have a series of candles that closes above it, they'll always, not always, I don't want to say always, but they'll present two candles to you. So in this case, being that we're going up, this opposing side would be the bearish candles. So you would like to take the second candle, this body, the top, not the bottom, the top of the candle closure on the 1 minute, two candles before the closure above swing highs or swing lows, right? And this is where I set my take profit. And I targeted, being that we were trading based off of a 15-minute time frame and a 4-hour gap, time frame alignment would be a 15-minute PD array because we were trading out of a 15-minute, so it would make no sense for me to target, like, let's say an hour, and I'm going to show you why I didn't target an hour. I want to let me. Okay, I targeted the CE. I put 10 points. And I'm going to show you exactly why. Let's just do this. Okay. Okay, boom. We got tagged in. Take profit was right here. Look what ends up happening. And I'm going to show you why you have to use time frame alignment, right? Like I said, we traded out of this 15-minute swing high. We had the SMT here, and because we used 15-minute, this was the PD array that presented itself in the 15-minute time frame, right? Now, when you look on the 1 hour, what was here? There was nothing here. Okay, like originally I wanted to go with this. This was the secondary leg. We have straight downwards price action without any rebalance here. But I already knew since we were trading out of the 4-hour gap and the 15-minute presented its rebalance, I knew we would eventually trend lower to sweep out this liquidity and to continue to displace lower before going back up. This was just a rebalance here, and that's why you need to use time frame alignment. It's basically what order flow is. This is how. Why would we continue longer if we can't get a closure above this last swing high? You understand? Like this was a short-term rebalance. This is where price needed to rebalance, and that's why if you're using your time frames, use them in alignment with one another. Don't just look on the 1 minute all day and base everything off of a 1 minute. A liquidity sweep, an inverse, a fair value gap. If you go to 1 minute, like, where would you know how to exit here? I mean, I guess you could say this is an order block, but really, realistically, look how many other order blocks look the same. You got one here. You got one here. And vice versa. Like, it wouldn't make any sense. Like, same thing here, right? Now that we displace lower and we're displacing out of a 15-minute gap, this would be the low, Yeah, this would be the low. There was S&T here. This would be the low, right? No liquidity has been swept. This is the major low on the 15 minute, right? In this case, this would be your target for a re-entry. Why do I pick this one? It was because there's two candles here. Before displacing lower, this is the candle that set the movement to go lower, and there's also a devil's mark here, and you could have even entered just based off of this, in which a student of mine ended up taking, and you could have targeted these lows. Okay, or you could have went, if you didn't want to, like if you wanted more movement than that, you know, you obviously look around. Maybe you could have targeted this where the S&T was, but for me I would have been fine just based off of this. That's just me. It's Asia. I don't really expect much out of Asia. This low right here, what ends up happening, okay, we displace all the way lower before coming back up. We sweep the low again, and then we eventually displace higher. But at this point, like 50 points during Asia is like he just hit the jackpot, to be honest with you. If he didn't catch this move down, like, you know, this just based off of a re-entry to catch 50 points is pretty impressive. The same goes for being bullish. I guess I'll throw an example in there for bullish. It kind of makes no sense to really. Once we get a closure above, this is the major high. We get a closure above it. You get some form of a gap here. Let me see. Let me go back to the 5 minutes so I could just rewind the time to over there because it's gonna take forever to go back here. Okay, we got a candle closure above this high. Okay. You could have entered off of that gap, or you could have entered off of this. Do we have something? Okay, you could have targeted the gap fill, to be honest with you. I mean, to really target all this up here is just crazy. If you, let's just say you entered on the retest here, to fill the gap fill, you would have got 150 points, just based off of order flow, not any other mechanical approach or anything else like that. Just based off of using literally a closure above a swing high and the first, you could have entered even right here if you wanted to. Like here, this is we're rejecting after sweeping above. You could have entered, you know, once you had a solid close and a retest. You could have entered off of that. You could have entered off of this gap. Do we tap into it? No, this one. Come on. Gap fill is still 120 points even from here instead of getting smoked over here. If you're not that much of a confident trader to get in at this point, then you know it could have worked out for you either way. For those of you who already know, like when there's a long wick, we use the golden approach. If there's a short wick, we use the 25 or the 50. But yeah, it's pretty much sums it all up. I gave you the example in the beginning. It's order flow is continuation down. This is the swing high. Unless we close above it, we don't look to go long. We shouldn't look to go long, and if we are going long, as long as this doesn't get closed above and there's a rebalance here that we're tapping into to potentially displace lower, like, then we should be fine. We'll it'll probably displace back to here before going higher, like right here, before going higher, and then sweeping out this major high. Just stuff like that. Like, you guys just use the example that I gave in the beginning of the video, and let's just go with 4 hour again. 4 hour yesterday, 15 minute is in alignment with the 4 hour. 1 minute is in alignment with the 15 minute. And true here, target the 15 minute, not anything else, because we're trading based off of a 15 minute. Here, and we displace lower. So please, time frame alignment, please. I'll type it out for you guys. Time frame alignment. I can't make this like any more clear for you guys. 4 hour, 15 minute execution. 1 hour is a 5 minute execution. Okay, 5 minute is a 1 minute execution. Well, wait, let's go to 15 minute. 15 minute is a 1 minute execution. And then 5 minute is obviously a 1 minute as well. And what I mean by execution is like, you see how yesterday's example, even today, a 4 hour, 15 minute, we're gonna base it. The execution is gonna be based off of the 15 minute. Like, if we took a trade based off of the 4 hour, do you know how quick we would get smoked? Just because of how like much price movement is in 4 hours of one candle. So, with that being said, it's like, why would I take this trade when I know, like, how many times does a 4 hour candle actually tap the CE of something and then just reverse off of it? We all know that doesn't really happen like as often. And if it does, it's like, wow, like, that was a really strong PD array. But for right now, time frame alignment is what's gonna really simplify all this stuff. So please, this is very important right here. This very important. Yeah. So that's about it for order flow. I hope this video helps. It helped me. It really kind of like recalibrated everything, because I spent a lot of time focusing just on like the mechanical approach that I was even forgetting. Like, why am I taking a short here just based off of like my standard deviation approach, when I could just wait, be patient as what a trader is supposed to be, follow order flow, and base my mechanical approach alongside with order flow and add the time frame alignment. Like, it's like, look how easy that sounds. It's very much more easier than just taking a random fucking trade just because like I feel like I need to take a trade, or I'm impatient and I need this to work, and all that other stuff that mostly everybody goes to. So with that being said, it's like, you kind of can't lose with this. The only way you'll lose is if you enter early, or you're impulsive, or you just hold a trade that's just, the market's unpredictable. Anyone that tries to portray that they can predict the markets, it's not true. These are probabilities. Trading is based off of probability. Like, If you have probability and that's your edge in the market, there's multiple things that could probably happen. It's our goal to figure out what the probability is of this happening, that happening, and like with order flow, it's kind of like you're following the trend. So like 9 times out of 10, even if you do catch a wrong or an early trade and you do get stopped out and you have the proper risk management, another opportunity will present itself. It's up to you to figure out how you want to go about it. So I think with that being said, it's like kind of like impossible. So this is your edge in the market right here. This is order flow. I hope this helps, guys.